Okay, we're going to get started. All right, first thing we're going to look at is the Yahoo Finance homepage. Okay, we can see that the stock market is doing pretty good today. You can see most of the major averages are up. We had a good earnings report from Netflix. Netflix stock surges after earnings. So this is the time of the year where we have the earnings coming out. Let's look at our meeting notes. We noticed that tech earnings come out. Netflix started it off today, so that's the 18th. So we're going to have all the tech earnings come out in the next 2 weeks or so, and then the video will be last. So that's why we have usually have a good October, because October is traditionally a good, has all the earnings coming out, and right now we have a lot of momentum in the tech stock world. So let's look at the Yahoo Finance homepage, see if we can see any good things. Um, CVS, we've been saying CVS and Wall Street have been pretty under pressure due to competing business business models. So right now the Walgreens, CVS are challenged by Amazon direct mailing prescriptions and Cost Plus by Mark Cuban. So the business model for the pharmacy people, it's not, it's being challenged. So that's why CVS is having a problem. Walgreens is down 90%. So that's not a good sector to be investing in. All right. So what else can we see from here? Um, we can see sector does good. So it's and same thing as the sectors go down in sympathy. So let's look at some of our meeting notes. Okay, so we know the earnings are coming out for the next 2 or 3 weeks. We expect November and December to be good because there's all kind of seasonality um, around this time of the year. We have companies buying back stock, and we have companies that we have pension funds that need funded. There's a lot of things that happen in November, December that causes the stock market to go up. And we have good feelings around the holidays. We have Thanksgiving holiday and we have Christmas, so and New Year's. So three of the biggest holidays of the year are in these months. So that's why normally it's a good time of the year for the stock market because there's good feelings. Um, and let's see what else is happening here. Okay, so we have a lot of momentum in the stock market. You can see now that almost 80% of the S&P is above the 200-day moving average. That is a true sign of momentum. Um, so, so the stocks are actually um, in rally mode right now. Um, it seems like there's a market is pricing in a Trump presidency. Whenever Trump is president, he's going to have less restrictions on the banks and the oil industry. And those are two major sectors that have a direct help from the president. I mean, President Trump, if he's elected. Um, and we know that the Fed is reducing interest rates. So we have like a Goldilocks situation where Fed is reducing interest rates. The economy is doing pretty good. We have more certainty in the presidency, and we have momentum, and we have earnings coming out that are better than expected. All that combined leads to, us thinking that this month is going to be a good one, and the months going forward are too. So, but we are overbought right now. The Treasury is going up. The U.S. Treasury is going up. So usually, let's look at our Treasury. Okay, so starting October 5th, we've had a situation where the Treasury has gone up in yield, and the S&P has gone up, and that messed up our inverse correlation for the longest time. So now it seems like whenever the interest rates go up in the 10-year, it seems like the stock market goes up with it. So we'll keep watching that. Let's go back to our talking points. Let me see. So it looks like we're going to rally into the election, and with the certainty when when we have certainty in the election and we know there's a new president, that'll allow the stock market to um, appreciate because when there's less uncertainty, stocks go up. All right, what other things we have to look forward to? That's it. Um, all right. So we can see October, November, December are traditionally good seasonality months. Um, September was actually a decent month this year. It was actually up 1.5%. So seasonality didn't work out this year for September. But for me, I'm 100% invested at all times. I just try to time the market whenever I'm introducing new positions. Let's look in at the S&P 500 for the stochastics. You can see we've been overbought for over a month and a half. So, and the stock market continues to climb a wall of worry, they call it. And we're overbought at 84. That doesn't mean that we can't continue to rally and keep going up. But if we have a bad earnings report, we'll most likely go down to the bottom end of this range. And before we go up at the end of the year. So that's why we watch this chart just to make sure that our everything is within our trading ranges here. What else can we look at here? Okay, let's look at our the inverse correlation stopped October 5th with our 10-year Treasury and the S&P 500. So now we have a one-to-one correlation as the interest rates go up. That kind of tells you that the economy is doing good and the stock market goes up with it. So that's what's happening right now. 2-year Treasury, same things happening. Okay, now let's look at the major variables in the stock market. The price of WTI crude is down 5%. So that's either it's a slowing global economy or more supply is on the market. It seems like more supply is the reason why it's going down. Let me see. Okay, so let's see okay, inflation is still around 2.44%, and that's good. A dollar index is up 1%, and gold is up 1%. Usually these don't go up together because a stronger US dollar tends to drive gold prices lower. So maybe there's just a people wanting to get ahead of inflation and maybe some central banks are buying gold. So right now that there isn't a correlation there. But gold has been one of the better things to buy this year. Let's look at um, let's look at some more talking points. The fear week. So all indications are the stock market is in rally mode. We're in greed. Individual investors are greedy. They're bullish. We have the Fed. We have earnings reports coming out now that are better than expected, like Netflix today. So everything is pointing towards a continuation of the rally. The one thing that could stop this is, a really bad earnings report from a big company. We haven't had that yet, so we'll see. Okay, the VIX is 19, so people are less fearful than they were last week. Hey, hold on. Okay, so we have people are getting to the point where they're delusional. Everyone's buying, everyone's greedy right now. This is the emotional chart. Um, and let me see. Usually the when people are buying and greedy, you don't want to buy when everyone else is. When everyone is fearful and capitulation, despair, that's when you want to buy. And let me see what else. Okay, so the uncertainty in the market, things that might lead to a crash, the things right now, the biggest uncertain thing in the stock market is um, the election. That's going to be resolved within 30 days. Um, we have we have some brinksmanship talk about world wars in the Mideast and Russia. Any kind of any kind of world war that starts and that could lead to a crash. Um, you see, all right, and we have possibility of a random um, Trump comments. If he's president, we might wake up tomorrow with tariffs, 190% tariffs on all imported goods, and that could really affect the stock market. That could cause a crash. Um, so let's keep our eyes open for any of these things because at that point in time, if these happen and the stock market goes down, we have to say, does that affect the long-term potentials of the stocks we're investing in? Okay, so all right, so let's look at, let's see. Okay, let's look at our worst to first. We always do this every week. You can see that the utilities, the worst from last year, is one of the best for this year. We have the QQQ, the information technology, up 32% this year. The utilities are going up because they're high yield. As the interest rates are going down, there's a big build out for that. And energy last year, we're going to watch for next year. Energy is if there's a Trump presidency, perhaps he'll be less restrictive on drilling permits, and that'll allow energy companies to prosper. Um, let's look at communication services up 27%, industrials up 22%, financials up 26%. Now, there's been a big shift in the stock market in the financials this week and last week, as Trump is projected to be a winner due to the Electoral College. Um, the financials will be one of the best beneficiaries because if there's less regulation, then the banks will do better. So we're going to watch the financials into next year. And okay, that sounds okay. That sounds pretty good. Now let's go to our sectors. Let's look at our sectors that are going up and down today. Okay, U.S. market movers. Okay, we have Lamb Weston. They are the largest maker of French fries in America. Um, Netflix. They had a really good earnings report, and Blackstone. We have CSX. They went down a lot the other day, so they're going up a little today. Um, let me see. I don't see a theme in these. No, I don't see a theme. Okay, let's look at the top decliners. CVS. Okay, they had that um, bad announcement today, and I guess do we have? No, we don't have any other um, benefit. I mean, prescription fulfillers on this list. We have Archer Daniel Minden. We have a lot of at least some gas company, some oil companies. Halliburton. We have um, American Express is down. This is one we've been following. Perhaps this could be a time to start looking at this. American Express. They're a fintech company that issues credit cards. So this has been in our screener for the past couple of weeks. Sometimes whenever you have a screener, let's see, I'm going to pull up the screen screener for this week. Okay, so let's look to American Express. There we have it. We have it's 35% overvalued according to the PEG ratio. We have it's growing around 15% a year based on these numbers. Okay, we have return on equity 34, which is really good. They're a very efficient company. Um, okay, so the good thing about American Express is they have clients that are wealthier. So they make people pay like a fee every year for their card, but there's a certain um, draw to for customers that are higher, um, they're wealthier. So because of that, you don't have as many um, people defaulting on their card payments. So we're going to look at that. It's a little expensive right now, 35% overvalued. But, if there's a big sell-off in this stock, we can start looking at it. Let me see. What other stocks are going up and down? Okay. Okay, I don't see any theme here. That's okay. Let's look at the NASDAQ. We have, okay, I don't see any themes in these. Okay, I see a lot of healthcare stocks. We have biotech, Vertex Pharmaceuticals. We have Moderna, a biotech, and Gilead. So these are all stocks that make medicines. And we have Arm Holdings. These are chip stocks. So it's stocks that sell semiconductors. Um, so it's interesting. And why they're Qualcomm is semiconductor, ON semiconductor. All right, so let's look at the ETFs, the ones going up and down. Let's look at the 10-year is going down today. So anything that is interest rate sensitive, we expect to be doing better. So let's look at the sectors. Okay, so we have interest rate sensitive stocks. Okay, I would expect the regional banking to be up today because if the interest rates are going down, that would help the banks. Um, Home construction. Okay, so home constructions help because if the interest rates go down, then there's more house, it's more housing is more affordable and they sell more. So that's why the housing sectors are up today. And you see, okay, so utilities are up because as interest rates go down, there's a demand for yield. So, and healthcare has a high yield in that sector. So as interest rates go down in the 10-year, we have a demand for yield. And okay, healthcare, utilities, and telecom, they're high yielding also. Um, and okay, real estate ETF. Okay, so we do have we the themes as the interest rates go down, we have sectors that do good or do worse because of that. And the oil stocks, they are doing bad because the price of oil most recently is going down. Let's look at the pre-market to see what the price of oil is. We have to wait a little bit. Well, it's taking a long time. Okay, commodities. Here we are. Okay, so crude, WTI crude oil is down 1%. So that's why we have the market move, the sectors of oil being down today. All right, so as a reminder, if you invest in oil stocks, even if you have the best run company, you're still at the mercy of the price of oil or energy. So you have to be willing to go up and down with the price of oil, and that's just part of life in investing in oil companies, in energy companies. Okay, so now let's look at some more of our talking points. Okay, okay, so let's look at, okay, Dan Now's picks from the beginning of the year. I can't wait for his 2025 picks. Amazon up 23%, about what the stock market is. The S&P is up. Meta is up 63%. They're benefiting from the political ads. And actually, I've heard stories where the Harris campaign is spending big to get their news stories in the feeds of people. So Meta's up 63%. Texas Instruments up 18%. It's like a market performer. XBI, the biotech ETF, up 12%. And KWeb is up around 20%. All right. So Dan's picks did really good this year. Let's look at some of our earnings that are coming out. Okay, so we have this week we had Netflix come out yesterday. We had American Express. That's why they're down today. They had earnings out today. Um, American Express, that'll tell us a little bit more about the consumer and how spending is. It seems like from what we've heard from other companies, from the banks, that the consumer is spending and it's doing really good. So there is no recession on the horizon. Next week, we have Alphabet, Microsoft, Visa, Verizon, all in the same day. Um, that has a chance of rocking the stock market based on the earnings. And we have a lot of big names coming up. We have Coca-Cola, T-Mobile, IBM, AT&T, Amazon, AbbVie. They're all coming out next week. So it seems like the consumer's doing good. We had a hint from American Express. They went down a little bit, so Visa might be in trouble because of that. Usually they trade together. And you see. All right, so that'll be interesting to watch that next week. Um, okay, so I'm bringing up a chart from Procter& Gamble last week. We mentioned last week that we had an oversold condition, and the stock was at the bottom of its trading range. So we don't get that very often, but you can see this week it actually the stochastics started getting to a improving, and the stock went up a little bit. So now we're halfway between the trend lines. So all right, I'd like to follow up on stocks from last week that we talked about. Okay, so there's an article. Jim Cramer says Alphabet um, is the most incredible bargain in the world right now. So whenever I see a title like that, I think, wow, we gotta look into this a little bit. All right, so hold on for a second. All right, so Jim says that Google search revenue jumped 13% year over year. So it seems like this company is growing at 13 or 14% a year regularly. It's really hard to find a compounding company that regularly um, grows at 14%. So that means basically if you buy it now in a year, you'll probably average a 14% return. Okay, so Google has 91% share of the stock of the search engine market. Um, So in 5 years, no, 5 years since December 2019, they lost 1.65% of the market, most likely to Bing. So Bing search market share increased from 3% to 3.91%. So they're not making a notable dent in Google's market share. Um, so Google has a lot of their growth part of their company, YouTube and cloud. Um, they're growing the fastest. And they, of course, also have the Waymo, which is probably not even in the numbers yet. And they're making deals with Uber and to deploy their Waymo. So that's not even in the estimates right now. So I'm pretty excited about holding this company, even though there's antitrust. I think we have the government possibly breaking up the company, but if there's a Trump presidency, they might just drop the whole thing. And also, it could take 6 years or more for appeals to happen. So they'll be earning 14% for the next 6 years, until this whole thing drags out. Um, so another thing that Oakmark, uh, the guy that runs Oakmart Select Fund, he says that they implemented these. You can choose your provider. For instance, in Europe, they made you, they made it so that people can choose the search engine that's default, and almost everyone chose Google, so there was no effect on their market share in Europe. So he thinks that that same thing is going to happen now in America. People are going to say, "Do you want DuckDuckGo for your primary search?" No one's going to choose that. And the good thing for Alphabet, they won't have to pay $21 billion to um, Apple. So if this antitrust is one of the remedies is they can't pay Apple for prime default search on their app, then they're going to save $21 billion a year, and that's going to help them. And they'll still retain their market share. So that's what I'm thinking. But it's still a little bit sketchy because of this government trying to break them up. Uh, but that's interesting to read what Jim Cramer says about that. Um, you can see from this chart, Alphabet is definitely in an uptrend. You can see that they're halfway between overbought and oversold. Um, and it's a well-established uptrend in channel lines. So everyone in the market is watching this. And whenever it gets down to this point, if we sell off, um, people will buy it, and then it'll go up here like at the end of the year. Okay, so the times to buy Google are right here. You can see that it's oversold at the bottom of its trend line, and you can see the RSI is down really low too, the MACD. Um, so right now it's like, nah, it's not a good time to buy or sell. It's right in the middle. All right, so let's look at the valuations for Google. We have $2 trillion market cap. Forward PE is 18. PEG ratio is 1. So Yahoo Finance thinks it's 11 times overvalued. No, not 11 times, 11% overvalued. Their profitability is 25. That's excellent. And return on equity is 30. That is excellent. Is super. So that's great. So if we look at their earnings, okay, if we look at the earnings estimates, we can see that last year to this year, they grew 32%, and they're growing around 14% for the next couple of years. So, so it's a compounder. It's not easy to find a reliable compounder. Um, so the pros are you won't have to pay Apple 20 billion a year, and that's going to really increase their profitability for search default search if that ever happens. And it'll take 6 years or more for antitrust things to happen and to really have a resolution for that. Microsoft, it took them 6 years to go through their um, process for antitrust. So so we don't know. The bad thing is that that's a hang over the company. We have Waymo, this driverless cars, which is they're deploying around the country. That could be an add to their revenue. So we don't know what's going to happen there. Okay, let's look at we did a stock screen. I already went over the stock screen. Um, and I looked at some of the more interesting stocks in the screen. We had two stocks come out with earnings reports this week that are better than expected, Taiwan and Netflix. And they were at the top of our lists for ages in our screen. So I thought it'd be interesting to go over these again. You can see that Taiwan Semiconductor, it's grown around 20%. There's 20s in all these, and they're the green highlights are the top 25 in our screen. So I ranked I ranked every one of these, and the top 25 numbers for each is green, and then the next 25 is yellow. So it looks like they're doing pretty good. They're growing 20%, and they have an insatiable demand from NVIDIA. They said they can't keep up with all of NVIDIA's orders. Okay, so we're going to go over Taiwan Semiconductor. We're going to go over Netflix and New Holdings. New Holdings is a fintech similar to American Express or Visa, and they're big in Latin America. And it's according to this, they're 15% off. They're growing a lot. Look at these numbers, 50%. And um, and Warren Buffett owns New Holdings also. So if Warren Buffett owns a stock, it's a good check of approval. And let's go over some of those. Um, let's go over some of those now. Okay, so um, TSMC had a news story that they popped 10% after quarterly profits soars on AI demand. Okay, on the year, and they're the world's largest producer of advanced chips, and so they have as much business as they can get right now, and so that's really good. That's similar to Eli Lilly. Eli Lilly has more demand for their weight loss drug than they can make, so that's why I'm interested in Eli Lilly. But this is a really good, um, it'll be good interest. I mean, interesting thing to review right now. Okay. Okay, let's look at Taiwan Semiconductor. I did a look at their earnings report, their earnings estimates for the next couple of years. It looks like they're growing around 25% right now. So if they're growing at 25%, their PE is 22, their PEG ratio is 1.1. So they're about fairly valued, maybe overvalued by 10%. Their biggest customers are NVIDIA and Apple, and there's an incredible amount of demand. So they can basically have a good earnings outlook and steady um, amount of money coming in for the company. So that's really good. The bad part is you have a growing geopolitical issues with China. You don't know if Taiwan's going to be taken over for some reason or attacked, and maybe this stock might be turned over to the Chinese for free or something. Okay, we don't know what's going to happen. Okay, so let's look at their numbers. They're around a trillion in market cap. They have a PE PEG ratio, a PE of 22, a PEG ratio of 1.29. So they're 30% overvalued according to Yahoo Finance. Profit margin is 37, which is good, and 26 return on equity, which is really good. We like 13 is our minimum for profit margin and return on equity. They have $2 trillion in cash. Can you believe that? No, minus 1 trillion in debt. So that's $1 trillion in cash. That is pretty amazing. That's more than their market cap. So this is another stock that has more cash than what they're selling for. Their liquidation value, um, that's amazing. I wonder why they have so much cash. So that adds to the durability and the reliability of the company if you have a lot of cash on hand. Their cash flow is 1.5 trillion. Levered free cash flows. They make 622 billion dollars a year. That is pretty good. So I'm going to start looking into this company. Seems like a pretty good one. Okay, let's look at another one of our stocks on our list here. Let's look at Netflix. Okay, let's look at this has been at the top of our our screener because I sort by market cap. So Netflix has $300 billion market cap. They're growing, look at these numbers. They're growing around 25 to 30% if you look at all those numbers a year. They're 60% overvalued according to this quick screen. So I thought it'd be interesting to dive deep. Netflix is always sold at a premium. So it's always sold higher than its fair market value because it was growing very fast. So let's look at their numbers. We see their ad tier memberships jumped 35% and it beat on the top and the bottom lines. And projections, they gave good forward projections, which is good too. So their forward PE, their PEG ratio is 1.5. So Yahoo Finance thinks that they're 50% overvalued. The profit margin is 19, which is good, and 31, that's better than the 13 we're looking for. Total cash on hand, um, they actually are, they have 6 billion in cash, 16 billion in debt. So they have 10 billion in debt out of 300 billion. That's not that bad. So they're investing heavily in content. And their theory is if they invest heavily in content, they'll they'll have people regularly viewing their service and won't cancel. Okay, so if we look at their numbers, they're growing around last year to this year 60%, and then they're like 20%. So I'm using 20% in my numbers. Their forward PE is 31. So they're according to that, you divide the forward PE 31 by 20 and you get 1.55. So they're around 50% overvalued. So if you divide their current price by 1.55, you get a fair value of 458. So on a bad day in the stock market, or if they have a bad earnings report, the most that they will go down to is around 458, which is their fair value. The pros are that they're a leader in streaming, they're growing their ad business, and they're starting to add live events such as NFL games and boxing. And the bad part is they're overvalued, and it could drop if there's a bad news story. They could drop down to this fair value of 458. So we have to watch out for that. Okay, so we have another stock on our list here. Let's look at new holdings. This is a new stock for me. I had never saw it before, but interesting thing is it's owned by Warren Buffett at the Berkshire Hathaway. Um, it says that they have a PEG ratio of 0.85, so they're 15% undervalued for quick math. They're growing. Wow, it looks like they're growing like 50% a year, according to this. So they have some of the best numbers in our whole screen. So I thought it'd be interesting to go over that. What do they do? They're actually a um, financial fintech company. So they do processing similar to Visa, MasterCard, or um, like companies that are like American Express. So let's look at their financials here. They're a smaller company than Visa, MasterCard, but they're pretty big in Latin America. So they're like a leader fintech company in Latin America. According to this, they're growing around 45% for the next couple of years. They don't go past 2026. But it seems like they're half off right now. And their fair value is around 28. They're at 14 right now. It seems like their fair value is around 28. Um, the bad part is they're a small cap stock and there's not as reliable. There's not as many analysts covering this stock. So um, this is a kind of stock that will drop like 10 or 20% easily because there's not a whole lot of volume and there's not a lot of coverage on the company. But this could be a stock that's a growing company. They have a foothold in Latin America, so um, it is a company doing business overseas. But I'm going to watch. All right, our company. Let's look at it again. Its Ford P is 23. Yeah, for some reason, Yahoo Finance doesn't calculate a PEG ratio, so we think it's half off. Profit margin is 24, which is double what we're looking for. The total cash is 6 billion if you cancel out the debt. And so that's 6 billion in cash, which is pretty amazing for a $67 billion company. So they're well capitalized and they're growing and they're positive on their cash flow. So this seems like a pretty good company. Um, they don't have a dividend. All right. So um, one of my themes in my portfolio is fintech. I have a lot of fintech in my portfolio right now because the reason I like fintech is they have minimal costs servers and people to run the servers, and they charge just a fee, a transaction fees, and that increases as economies grow around the world. So, and they're very profitable, the fintechs. Usually, Mastercard has, really big numbers, and Visa have really big numbers for profit margins, and so this is another company that's an upcoming company that could um, be in addition to that fintech part of a portfolio. Okay, so that was all I really had to say for today. I think that's about it. I hope you enjoyed the talk, and hope you have really good um, success with your stocks next week. And I'll see you all next time.